The United States borrowing binge continues with the recently announced plans to borrow $776 billion in the final 3 months of 2023. So there's a couple things that we've got to look at here. Number one, where's this money coming from? Obviously they're borrowing it, but where is it coming from in terms of, are they borrowing it short term? Are they borrowing it long term? Number two, how is this going to affect borrowing rates into 2024? Are we going to see the deficit expand even more, or is it going to shrink? And number three, what is this going to do to interest rates? Obviously, all else being equal, we would see extra borrowing would mean higher rates, but they don't have to borrow all at one end of the curve. So how will this affect the yield curve? All right, so first we have to notice that the US government borrowing is actually declining in the final 3 months of the quarter. Looking at July through September, they borrowed $1 trillion, which makes the $776 billion the borrowing in the final 3 months look small in comparison. But don't worry, everybody out there who just loves the government borrowing more and more, you're gonna get your wish, because the Treasury also announced that it will be borrowing $816 billion during January through March, which is over $100 billion more than what Wall Street estimated it would be. But when we throw around hundreds of billions of dollars like this so casually, it can all seem benign. So what does it look like in context? Well, during 2023 fiscal year, the deficit ended up being just about $1.7 trillion. This was $320 billion higher than the year before, which was 23%. Now remember, deficit just means the difference between what you spend and what you make on a personal level. We know the government doesn't make any money, they take every dollar that they spend. And so when they take money in taxes and then spend more than that, they have to borrow the difference. That's the deficit. Every year, the deficit is just the amount that gets added to the total national debt. That's the total amount that they've borrowed over the years. It's also important to note that this national debt is debt, and what happens to debt? You owe it back, which means that every once in a while, one of those 10-year treasuries or 20-year treasuries or 1 month or 6-month treasuries, any amount of that they've borrowed every once in a while has to get paid back. And how do they pay that back? By borrowing again. Basically a credit card balance transfer. That's the name of the game for the government. But if $1.7 trillion for a deficit wasn't enough for 2023, don't worry, because analysts at TD Securities expect that in 2024, the deficit will increase yet again to 1.85 trillion. Now, over the course of 2024, we have about half of the national debt set to mature, which means they'll have to roll that over. And for any of that debt that they borrowed in the last decade or so, they borrowed it at much lower rates than what they have to pay now to borrow new debt. So the borrowing is increasing, and the cost of that extra borrowing is also increasing because they're paying off old debt, which is low interest rate debt, by borrowing new debt, which is high interest rate debt. By the end of 2024, we will see the United States government paying around $1.2 trillion in interest payments alone. We've seen the interest payments on the national debt over the last couple of years skyrocket from a few hundred billion all the way up to almost 1 trillion. And by the end of 2024, we'll probably be in the neighborhood of about 1.2 trillion. So it's still moving higher, still quickly. Now, for those of you who are not aware, the US government maintains a checking account of their own, and it's called the Treasury General Account. This account looks like it was not used prior to the Great Financial Crisis, and that's because it really wasn't. Prior to that point, the United States government kept their money inside the banking system, but because of the quantitative easing that was taking place in some of the mechanics in the belly of the banking system, the Federal Reserve was concerned that some of the money printing would contribute to reserves that were too high for the banking system to be able to handle. And so what they did was they moved the United States government's checking account to their own balance sheet. So instead of the government having their bank account inside the banking system, they moved it to be held directly at the Fed so that any money inside the government's checking account would not be inside the banking system. So that's why this account started to see usage following the Great Financial Crisis, but usually was maintained around the $300 to $400 billion mark. Once all of the borrowing and money printing skyrocketed in 2020, the account saw a record high balance balance of $1.8 trillion. That was a result of borrowing all the money that the Federal Reserve had printed before they were able to go out and spend it. They started spending it, and then upon the election of Joe Biden and Janet Yellen becoming the Secretary of the Treasury Department, they decided they would spend the account back down to more normal levels, and spend they did. The problem was right around here, we saw a government shutdown start to take place, in which case they had to spend all of their reserves down to almost zero before they were able to refill their coffers again to a bit more normal levels. Throughout the course of 2022, they maintained levels around the $500 to $600 billion mark when yet again, government shutdown rumors and news started forcing them to spend this money down to zero yet again. And finally, towards the end of 2023, where we're at right now, they've been able to borrow back up to the level that Janet Yellen feels comfortable at, the $600 to $700 billion mark. Like I said before, this is just their checking account. So whenever they take money in taxes or borrow money, it flows in. And then whenever they spend money to, I don't know, the military industrial complex, it flows out of there. Or the pharmaceutical industrial complex, it flows out of there. Or Social Security, Medicare, healthcare, education spending, all of that, it flows out of that account. And the Treasury announced that it wants the balance in that account to stay at $750 billion for both quarters. So with it at $834 billion right now, we should not expect to see significant movement here. Basically, all the money that they borrow from here on out, they will spend as they'll maintain the same level. So everything coming in will also go out. Now, on Wednesday, the United States Treasury is going to announce the sizes of its auctions for bills, notes, and bonds. This is significant because if they decide to borrow all at the long end of the curve, then rates at the long end of the curve will move much higher from where they are around 5%, potentially up to even 6% very quickly. But obviously, they're not going to do that. They're likely going to spread it out, although they most likely will lean a little bit more towards the long end of the curve, simply because they've been relying so much on the short end of the curve recently. So let's explain that. Why have they been relying on the short end of the curve, and why will they rely a little bit more on the long end of the curve in the coming quarters? Well, if you notice, even though they've been borrowing at the short end of the curve a lot recently, the rates really haven't changed. They've been holding steady at around 5.5%. This is because of the money that is in the reverse repo facility at the Fed, which used to be at about $2.3 trillion. And over the last 6 months or so, we have seen the balance decline all the way to about $1 trillion. So over $1 trillion has left the reverse repo facility at the Fed, and it's gone to be loaned to the United States government at the short end of the curve there. Brief explainer on that. Basically, the Federal Reserve has this account that they tell financial institutions, hey, if you put your cash with us, we'll pay you 5%, a little over 5% to keep your cash here. So most financial institutions do that. That's why you have some new high yield savings accounts like Apple paying decent amounts, why you have money market funds paying over 5%. They're keeping most of their cash in the reverse repo facility. But as interest rates that the government is paying to borrow at the short end of the curve have increased to a little over 5.5%, that has become more attractive than what they were getting to keep their money in the reverse repo facility. So the dollars have left to go be loaned to the government instead. This isn't a secret, and the Federal Reserve and the Treasury are both fully aware of how this works. And they are aware that there's about $1 trillion left in there to be borrowed at these rates. But this is short-term money, which means that the people who have this cash are only willing to put it in short-term vehicles. This is money that has to stay extremely liquid, which means that none of this money is available for long-term debt, long-term loans, but it also means that it constantly has to get rolled over. So hypothetically, if the government has to borrow $2 trillion next year and they borrow it all at the very short end of the curve, that means every month or every couple of months, they have to borrow it again just to pay it back again. Now, it's a useful tool to keep overall borrowing costs as low as possible, but borrowing at the longer end of the curve, especially at the 10-year, is actually a little bit more attractive from a borrower's perspective, and it gives you a cushion of time between which you have to pay that debt back. And so during 2024, it is almost certain that we see a normalization of the yield curve simply from the US government borrowing more at the longer end. We'll see higher 10-year yields than we do 2-year. We'll see higher 20 than 10, and we'll see higher 30 than 20 and 10. This will be a result of basic supply and demand. There's only so much money available to be lent to the government, and the government is trying to maximize the amount of money they can borrow, which means minimizing the cost of that borrowing, at the same time minimizing the potential very near-term damage from having to constantly roll over debt all at the short end. In summary, interest rates are headed higher. Government borrowing is accelerating, and the cost of that borrowing itself is accelerating. If you're putting all of your bills on a credit card and you're also having to make balance transfers from one credit card to the other just to continue keeping your credit card balance alive, that is not a sustainable situation, yet that's the exact one that we find the US government in today. And to make matters worse, every time they're forced to do this, the cost goes up, that interest rate goes higher. And because the interest rate is higher, the cost goes up, that means next time they have to borrow more just to pay the higher cost. This is the meaning of a snake eating itself by its own tail, or in other words, a debt spiral. And in other words, a sovereign debt crisis. It's not imminent. I'm not predicting a complete market meltdown tomorrow. I'm not forecasting the death of the US dollar. And in fact, debt crises, being defaults, being deleveraging, are also bullish for the currency because the currency becomes more scarce. But I am saying that personally, I would not be a lender with long-term debt right now. I'd not be a buyer of 30, 20, 10-year treasuries, and I definitely wouldn't be long the market, especially using things like passive index funds, because when you own the same things that everybody else owns, that also means that when everybody else decides to sell, you go down too. So I definitely wouldn't be invested in a portfolio like that unless I was actively hedged so that I could profit off of the downside instead of just have to wait and sit and hope that some years later it comes back. If you need any help with that, that's what I teach members of Heresy Financial University to do. Link is in the description below. As always, thanks so much for watching. Have a great day.